Okay, welcome back to the show, everyone. Jeff Smith, Fairways and Finance, coming at you with a new episode. Exciting topic today. We're going to talk about interest rate locks. And, this is a timely podcast because of the volatility that we're seeing in the market right now. And so I want to take you through what is an interest rate lock, how does that work, when should you lock, what does it mean to lock, and what the different terms are, because it gets very confusing. And for the average person, they really don't know a lot about what that means. So let's first talk about how mortgage companies make money. And mortgage companies make money by closing loans, and they fund the loan with their own money using a line of credit called a warehouse line. And then they sell that loan. Most of them get sold to one of two government agencies, Fannie Mae or Freddie Mac. So when a mortgage company sells a loan to Fannie Mae or Freddie Mac, it might be a $300,000 loan, but depending on the rate that they selected, that $300,000 loan might be worth $310,000. So when they sell it to Fannie Mae gives them $310,000, and the extra $10,000 is their profit on that loan. And so the value of the loan itself is based on the rate, and it's based on the rate at the time that the loan was locked. And so when you lock a interest rate, you're basically reserving pricing from a specific day. So the government agencies, Fannie Mae and Freddie Mac, will allow lenders to lock a rate and basically guarantee pricing from a specific day so that their client can then go through the underwriting approval process and close on a home, which could take 30 to 60 days to close on a home. So that way they're assured of what their rate is, and the lender can close the deal, and there's no question marks as to whether they'll qualify for the payment if rates go up. So now let's step back and think about, as a consumer, when I'm looking at locking a rate, what should I be considering, what does that mean? So once you go under contract, in most cases, that's the option where you have to lock in an interest rate. I do have a program where you could lock a rate up front for 90 days, and then that allows you to go shop for homes. But those programs, the rate is a little bit higher than it would be if you didn't lock it up front. So we'll set that aside for now. Let's just talk about a regular rate lock. So a regular rate lock, once you go under contract on a home and you have a property address, that is when you can lock in a rate. So today's Friday as an example. If I had a client go under contract today and I give them a quote on what the rate is, I could lock their rate, which means that I am reserving the pricing sheet from today. And once the rate is locked, it will be set. So if market rates during the underwriting approval process go up, that client is not going to have to pay a higher rate. If market rates go down, that client also is not going to get a lower rate. They're going to be fixed onto that pricing sheet from today. So let's say that I locked the rate on a 30-year fixed rate mortgage at 6.5%, just as an example. And let's say that 6.5% was with 0 discount points. If the borrower decided that they wanted to buy down the interest rate, they could still do that, and it would be based on the rate sheet from today. So it's 6.5%, no points. It might be 6% if they paid a 1% discount point to buy down the rate. After I've locked the rate today, they could still make that change, and it would be based on today's rate sheet. So a week from now, if they decide, hey, Jeff, they give me a call, I'd like to buy down my rate from 6.5 to 6%. How much is that going to cost me? I could give them that number based on the pricing from today. So it all fall back to what the rate sheet was for today. Okay, so the benefit of locking is that you protect yourself if mortgage rates go up during the underwriting approval process. You are also taking a little bit of a risk that mortgage rates could improve during the underwriting process, and then you would not get the benefit of the lower rate. So whether you should lock up front or not lock up front depends on the environment that we're in. This environment that we're in this year and really dating back to, the last 6 months of last year, has been very volatile. And the mortgage rates have been very stubborn. And when I say stubborn, I mean that we've gone through some periods of times where mortgage rates start to improve and then they quickly shoot back up. So it's like we're thinking that rates are improving, and then all of a sudden something comes out in the news cycle and now rates are going back up. And so we just have not been able to really break down to the next level. We've been between 6 to 7.5%, with points and no points, basically, for the last over 12 months. So rates have been in that window for a long time. And so in this type of environment, I recommend locking the rate. Because I've had clients over the last 3 months who have wanted to float the rate to see if they could get an improvement in pricing during the underwriting process. And then what's happened is the rate that they could have got at the beginning of the process ended up being lower than what they locked the rate at 2 or 3 weeks into the process, because from when they went under contract to when we locked the rate, market rates worsened. And then ultimately you've got to lock the rate, about 10 days prior to closing. So then once we locked it in, it was a higher rate than what they could have gotten had they locked it at the beginning of the process. And that's happening because it's just very unpredictable with what the market is doing right now. So in this environment, because of what I've experienced with my clients over the last 90 days, I recommend locking for everybody right now. And I strongly recommend locking until we see a convincing move lower in interest rates. So if you're considering buying a home here this year, this summer, I would recommend locking in the rate for sure as soon as you go under contract. Now, in most cases, I prefer locking the rate up front as well. Unless we're clearly in an environment where it's like rates are going down and they've been steadily going down, then I might say, okay, yeah, let's float it for a little while. But here's why I generally recommend locking in any market, because if I go under contract and buy this home, let's say I'm under contract to buy a home for $500,000 and the rate is 6%. Now I know what my monthly payment is. I've got this number in my head. Maybe it's $3,000 a month, okay? If I lock my rate, I know that I'm guaranteeing myself my payment's not going to be more than $3,000 a month. Even if market rates improve, yeah, maybe my payment could have been $2,900 a month, but I know that it's not going to be more than $3,000 a month. If I float the rate and try and cross my fingers and hope that market rates go down, and they don't, and they go up, now I'm paying maybe $3,100 a month instead of $3,000 a month. I would much rather lose out on a potentially lower payment and guarantee that my payment's not going to be any higher. I think it's a lot harder to swallow when your payment is higher than you were expecting versus losing out on a payment that was a little bit lower than what you were expecting. Okay, so I think that's the safer play. The other reason I like to lock in an interest rate up front is most closings are 30 days. We generally don't see a big change in mortgage rates over a 30-day period. If we do, it's almost always higher. Mortgage rates go up faster than they go down. Typically, when mortgage rates go down, it is a slow, incremental improvement with some blips. So we go up a little bit, then we go down, 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 then we go up a little bit, then we go down, down, down. And it takes a year. It takes 2 years for rates to really come down in a significant way. Whereas when mortgage rates go up, sometimes we get some things in the news, we get some data coming out, and all of a sudden rates are just ratcheting up. And in a 30-day period, you could see them go up quite a bit. So most of the risk that you're taking is to the worst side in 30 days. It's not often that you would leave a mortgage rate floating and see an improvement more than like 0.25% or 0.3% in rate. It's just not that common. Does it happen? Yeah, but it's just not that common. So you're taking a risk of paying a higher payment in hopes of a pretty rare occurrence where you're going to get a significantly lower payment. So that's why, in general, I recommend locking up front. Right now, I am strongly recommending all of my clients lock their rate up front. I think it's just way too risky in this market, and there's no reason to risk it. So that's what it means to lock in an interest rate. You're reserving the price sheet from that day, and then the rate is set. And if mortgage rates improve or worsen, your rate does not improve or worsen. Now, one other element to this too, and this is one other reason to lean in the side of locking up front. If you lock your rate up front and we see a big improvement in the market in 30 days, which isn't very common, but let's say that happens. And let's say when I say big improvement, like let's say that mortgage rates go down 0.5% or 0.75% while you're under contract. You can do what's called a rate renegotiation. So let's say market rates went down 0.75%. There is a cost for the lender to unlock your rate and give you a lower rate. So if rates go down 0.75%, what the lender can do is reduce your rate by maybe 0.5%, and then they're covering the cost by building it into that rate. So you're not getting the full benefit of what the rate would have been had you locked it on that day, but you're getting an improvement in your rate. And the cost of that, is being paid by not giving you the absolute lowest rate, if that makes sense. So it varies from day to day. So there's not an exact, formula of like, this is how much that costs. It fluctuates all the time, but roughly 0.25%. So if market rates improve 0.25% or 0.375%, there's just not enough margin in there for the lender to cover the cost of unlocking the rate and give you a lower rate. But if market rates go down more than 0.5%, then you can do a rate renegotiation, still get the benefit of a lower rate, but you locked it up front to protect yourself. So, I mean, even as I'm explaining this here on this podcast again, just thinking this through, it just really gets me back into the mindset of like, I always recommend locking, always prefer locking. And I've had some clients who have wanted to float, and some of them are pretty savvy. And so I thought, okay, all right, let's float this and see what happens. And it just hasn't worked out. So protect yourself, take a little bit more conservative route, and make sure that you're not stuck with a payment that's higher than what you were anticipating it to be. So that is interest rate locks and how that works, and what I think you should do with those, and that's also, I think, really important for most buyers. Before you're shopping for a home as well, you've got to have a lengthy conversation with your lender to dial in how much is this monthly payment going to be. What are rates today? What is the rate that I'm eligible for? So that when you go under contract on a home, you've got a really good idea of what that cost is going to be. Because, at the end of the day, what the mortgage costs you, is your monthly payment. You pay your down payment and closing costs at closing. That's one lump sum, one-time payment. But then going forward from there, for 30 years, you're making that monthly payment. And so you've got to make sure that payment is comfortable and it's within your budget so that you don't get yourself in trouble down the road. That's Interest Rate Locks 101. Shoot me a DM or give me a call if you have questions on that. I'd love to hear from you. Love to hear your stories on how your experience has been with rate locks, and any way I can help on a purchase transaction of yours or refinance or any questions that you have. Hit me up anytime. I'm always happy to help. Take care.